How's it going, everybody? This is Ted here with some bodies and wicks, and got a little bit of a new setup, so sorry if it seems a little off tonight or a little strange tonight. Got the webcam set up a little bit different, but still here to do the same thing. You know, I'm still here to look good for the camera, and that's about it. I'm just kidding. Anyways, bodies and wicks. What is a body and a wick? It's a freaking candle, you idiot. Why are you even watching this if you don't know what a body and a wick is? No, I'm kidding. No, I just, that's why I call it the bodies and wicks, because it's candles, trading candles. And I thought with my clever little mind, that's what I call it. Anyways, what I am is I am a smart money theorist, which means I do not believe in retail. So basically what smart money theory is that, you know, the charts are all algorithmic. They follow a specific algorithm that is basically price chasing either liquidity or balancing, right? So price is either trying to balance itself out, or it is trying to find liquidity, or both at the same time. Usually both at the same time. We don't believe in trend lines. Well, I'll throw in a trend line just to find out if I can see where the retail theory people are and to see where their liquidity is, so I can trade against them. And then, you know, no geometry or anything like that, you know, no, triangles or pennants or what else is out there that's, you know, bull flags, you know, bear flags, all that stuff, you know, it doesn't make sense. And also no indicators whatsoever. So basically it's just, we're straight chart. Smart money is straight chart, and trying to show you how to. I'm basically teaching you the basics of how to of smart money. There's a lot more to it than what I can try to show you in about 15-20 minutes. What I'm gonna try to do in this video, but I will try to do as much as I can, and to explain to you why we are where we are with Matic right now. That's what we're going to go over in this Smart Money series, quick analysis series, basically. So why don't we head over to the chart, huh? Let's do it. And before we head over to the chart, why don't we throw ourselves a little party here and put on some sexy music. Alright, now I got it going. Switch it over. So this is what we're gonna get into, and as you can see, it's a lot of boxes. I said, whenever I said no geometrical shapes, I meant like no trading off of geometrical shapes. Like no doing things like this, right? So this is something we're not gonna do today. Is we're not gonna go, oh look, a triangle. So therefore, whenever this comes out of this triangle and it comes back up, it's gonna go this way, right? No, this is not how it works. I mean, it could possibly do that, but it's not gonna be because of a freaking triangle. It's gonna be because there's liquidity sitting down here somewhere, right? Or it's attracted to one of these fair value gaps. That's the reason. That's exactly what I'm talking about when I'm saying, no trading off of any kind of geographical shape or any kind of trend line or anything like that, because you're gonna get sucked into something that you wish you wouldn't do. But right now we're on 15-minute chart. We need to get all the way out of here into the 1 month chart and go all the way in. That way we can show you exactly how we got to where we got Matic not been around that long. So Man, can you believe if you were in Matic at 2 cents? Well, I wish I was. I wish I'd have just, and that's the thing, is that there's so many coins out there these days, is that everybody's trying to get in at, like, the earliest of the earliest, and we don't know which one's gonna get there, and there's thousands of coins, and there's so many people. It's like nobody's ever gonna catch one of these and be a millionaire ever again, just because of all that. I mean, it's possible. It just, as long as you save your money up, I guess, and you keep going when, whenever the next bear wave whenever the next bull wave does happen, you can count on it. But, when I mean, algorithm, I mean, whenever there is interest shown, whenever there is money put into the market, yes, of course, the market is going to move. But it is not going to move exactly as if you were to put money into it. So you put $10,000 in it, there's not like a marker that says $10,000 that's gonna go boop, oh, $10,000 right here, and then you take out 2, oop, goes down to 2. It's not how the market works, right? So and instead it's more of like a pool of money, right? A pool of money that is put into one centralized place, and the algorithm kind of gets pushed around depending on if smart money is involved. If there's no smart money involved, you can kind of tell that the whole chart just kind of looks off. It looks really weird. But here you can definitely tell smart money is involved. Smart money is institutions, banks, large places, things like that. They're also trying to get in on, the early edge of these kind of things, especially Matic being 15 of the top crypto charts. If we go to here, if we go to cryptocap.com, we can scroll down and we can see here it is, Matic top 15. Can't believe it's up there with all these nice ones. Honestly, I can't believe that we still have XRP in the top 10. When is XRP ever gonna go away? That's just my thoughts, but that's just me. Anyways, back to Matic. Let's head on back to Matic. So anytime you have a 3 candle succession, you have 3 candle succession, and you have these wicks here. As you can see here, let me do this really cool. Well, actually, I shouldn't do that. Well, let me see if I can do it. Let me hide this really quick. See, as you can see there, between here and here, there is a little bit of a liquidity void, I guess you could say. It's not really called a liquidity void. That's something completely different entirely. But there is kind of like this void of area of like there is nothing, there wasn't no drawback. It didn't come completely back and touch this candle from this candle. Like if I do a line straight across, this candle didn't touch it. So that means that the price didn't balance. So because price didn't balance, what happens is it leaves what's called a fair value gap. Now what these fair value gaps are is they act as magnets, in both ways, meaning that it will attract price as well as repel price once they're closer together. So now that we are done with the monthly, since that's the only fair value gap in the monthly, let's head on over to the weekly. As you can see how this is the monthly was formed. We had the high, the quick jump up here, traded sideways for a while, then we had our quick bump up here, all right? And then you can see as it went up, it traded back down just a little bit. Always has, anytime you see a big push up, you're always going to see it get a little bit of a pullback, right? Same thing here, huge push up, but of course always get a little bit of a pullback. And then we had the only red candle up until this past week. So this one was the one that caused the high, right? So This one comes all the way back down, almost touches the fair value gap. As you can see, this one does, right? So as you can see, this guy right here, it wants to hang on to that bottom, but as you can see, it does actually come in to that fair value gap just a little bit. If we can open it up and get a little bit closer here, I wish it would stop drawing things and just let me do my thing. All right, there we go. So as you can see, there is a little bit, it does come into the fair value gap just a teeny bit, just enough for it to explode back out. That's what you want to see. All right, so this one comes back down, and it stops right here, comes down. So it comes down below this level here, right? So this level here, before it was just this level. So before you see this big red spike here, there's nothing there. So right here is what you would call, basically sell side liquidity. So resting below this area in a weekly time frame, there are people that have basically sell stops. So in case it does get below this area, they think it's going to continue to get lower because that's what retail tells them. Hey, it's almost like a breakout. In case it gets below this, it's going to break out and keep going lower. So there's people that have sell stops resting here, and there's also people that have buy limits with very, very short what's the word I'm looking for? I always forget this word and I can never think of it. Stop loss. They have very short stop losses. So you'll usually have the algorithm come down and then trigger the sell stops, right? But then also pull back up. That way they hit their sell. This is what I'm talking about with the liquidity pool here. So this is where their liquidity rests, because this is where the market, any kind of market limit is set. And when a market limit is triggered, it is set as a market order, and then liquidity is then released into the market. So comes down, hits below that area, right? So that, and then triggers the buy sell stops, as I mentioned. Also triggers the buy limits. So but these buy limits could have very, very short very short stop losses, and usually they'll set them above it, and they'll set the very bottom of the buy limit at the exact point of where that low is, maybe just a little bit lower, just because they think that, hey, this is the actual bottom. So and then so this thing comes down here, it strikes really quickly. Again, we're still talking about the weekly, but this could happen on any time frame, but I'm just explaining how these things work on especially on a weekly basis, how the searching for liquidity works within the algorithm, right? So just for this liquidity, basically takes out both sides. So it takes out the buy, it takes out the sell stops because it triggers them, goes back, takes out their stop losses, takes out the buy limits because it goes lower than what their buy stops are as well. So they're knocked out too. So smart money just knocked out two sides of the retail theory people in one shot. Now, why does it stop there? That is something we'll have to get closer on to find out. So, and we have a lot more to get to as quickly as we can. So we're going to the daily now. All right, so then the daily, as you can see, here is a fair value gap. All right, and as you move over to the fair value gap, you can see it gets closed in, and then that's when you get this big push down. Now, when the fair value gap gets closed in, that means that price is then balanced. Now price knows now price has been balanced. It can do whatever it wants again. It doesn't have to try to worry about the fair value gap. As you can see, it did come down in. It bounced out. One reason would be this order block over here, right? So this would be considered an order block. I think once we get to the 4 hour, we can probably see a little bit better. And you can see it pushed it way back up and out, moves back over. As you can see, it's starting to have some bearish tendencies because it didn't at this point on the daily, it didn't reach the top, so it didn't break market structure. So since it didn't break market structure, the next day we have another one, breaks down lower, back into the fair value gap, back up, and then another one back into the fair value gap, back up. And you can see it didn't stay in the fair value gap as it switched to the next day. Until the next day, it runs through it. So that, and whenever there is a fair value gap, it does usually just run through it if it is going to go through it. It does. Sometimes it does take some time to move itself through it. Those are the times when it's pushing really hard. It's kind of like an algorithmic battle. The algorithm feels liquidity one way, but it wants to go another. So again, long story. I can't explain smart money theory to you all in 10 to 15 minutes. So now we move over. We have this big long candle. And then boom, now we have this big huge shot up. So, and here we also have, now we're running another fair value gap, right? So you can see we come up, oops, do that. Now the thing is it comes all the way up here and it starts going back down. So the question is why didn't we break this? Why didn't we go higher? Well, that's something we're gonna have to take a look at and go closer and keep taking a closer look in on, because that's actually really important as to understand why we didn't actually break that. And that answer we can find right here, right? So this is the first time, I would say the first time, but this is what is an order block. If you don't know what an order block is something that is just generally within a formation. It is usually, especially if it's a high formation like this, it's the last candle up, right, before your other two candles, or your other candles pushing the opposite way. Generally, what you would see is one red candle overtaking this candle, the up candle, and that would definitely make it an order block. But considering there's two consecutive red candles together pushing down, they're not overlapping. This one doesn't have like a higher spike than this one. This one doesn't have a lower spike than the other one. These two candles basically are considered, you can consider them one, if you put them in, an 8 hour, candle block, and it would take over this candle. So here you have an order block. You draw that order block from the volume of the order block all the way over, and look, all these candles hit the order block. No, the volume, of course it spikes through quite a few times, but the volume of the candles cannot break through. So we have entered the order block, created some buy side liquidity, and now we have dropped down. All right, so now we have dropped down. Now we're going again downward because we haven't broken market structure. I forget exactly why I drew these, to be honest, but because I did this yesterday. Actually, I recorded this yesterday, but I hit a button Actually it paused and I didn't realize it, and so I didn't conclude it. So I'm redoing this tonight, and we're seeing where we're at. So so we get down to here. As you can see, this also, I believe, is another. I should have actually labeled these before I actually stopped doing this, but let's get down to the 1 hour to see if that is another fair value gap that I drew, which I believe it is. It is. So that's why I drew that there. It is a fair value gap as it gets all the way and reaches, well, and you also have an order block right here. So as you can see, as it comes up here and hits this order block, right, as we're dropping down to a lower level, boom, we hit this order block, which in the whole purpose of an order block is whenever it comes back to that same level, it's expected to at least be rejected the other way, at least 20 to 30 pips. Could be more, could be less, but generally somewhere around 20 to 30 pips is when you're going to see an order block reject something. So, and just to point it out, let's see if we even coming out in pips. I don't even know. Well, in Forex it comes out in pips, but I can't really tell from here. But it's about 10-11%. It's a good drop from the order block. So order block from here to these order blocks, right? So you have this order block right here, drops into this, bounces off of this one, right? Now you've created another, low level high, so which kind of equals almost these. So now you've created another liquidity level area, because now you created two areas that are almost equal highs to each other. So now the algorithm is going to remember this area, or this, and it also goes all the way across. Well, I drew it all the way across, but the algorithm will remember this area just because these highs are so close to each other that it's going to think that this is basically the new resistance. Everybody that is trading out there would actually think of this as a new resistance level. You could probably think of this as a new resistance level, but if you were to look at this and try to think as a retail trader, you would look at the area to where there's the most the area to where candles are being rejected the most from. So that would be this area through here. It wouldn't be up in here. This would just be kind of a fluke, you would say. But this area right here would be considered your new resistance level. So now as you're going down, right, because we're having we haven't broken market structure yet, we don't have anything that's pushed us up, we get into the fair value gap, the 1 hour fair value gap that is laying right here. And yes, there's another one just a little bit above it, but it's a tiny one. Of course, it actually goes through that one and is also rejected before it gets through this one, is rejected. And then it finally again blows through this one, and as soon as it goes through that one, boom, jumps right back up. So now we have another reason, or another fair value gap that has just been blown out of the water. So why it comes up here and stops, that is a good question. I do believe it is because of this bearish order block right here. Right, so you do have a kind of an up down area right here, and you have this red candle, right, or it would actually be the green candle, sorry, your last up move before your down move. But you have a doji candle right here, so maybe that's why it could also be considered part of the red candles, because it doesn't really go anywhere. So as you can see, if you were to draw a line straight across from here to here, oh, come on now. You can see that it did, the bodies again did not cross. So there's another order block for you. Boom, hits that order block, gets rejected even further. Now we come down here. Now we touch the monthly fair value gap. The monthly fair value gap. So this is the one we've been waiting for. Again, it doesn't go deep inside of it. It just barely even touches it, and then it jumps back out. So we still haven't balanced ourselves out in this monthly fair value gap, which is why Matic has been actually falling ever since it made an extreme high, because we still haven't balanced. So even though Matic today, it slowly went down, and it kind of made some moves to where it was going up yesterday and the day before. But look at this, like, especially when you have this big drive up. I think this is part of the product of, you know, being rejected off of the fair value gap of the monthly. Again, that's why I said it acts like as a magnet. It attracts it, but then it also repels it at the same time. So here we have a push up with the fair value gap, and another one with a push up with a fair value gap. Now this fair value gap, almost, you can see the candle sitting on top and then jumps down, closes it. After it closes it, now we're balanced. You really don't have to have this going all the way across, because we have balanced the fair value gap at this point. All right. So now that we've balanced it at this point, now the question is, where is it going to go from here? So it comes up, gets to this point again. Looks like it gets, I wouldn't say rejected by the fair value gap, but what it does is what I call, it creates fake liquidity, right? So you can see it's another one of those areas to where people would think it would be your resistance line. So once it gets close up to it, it would be an area to where people would start selling, right? And then if it does start selling, people will chase it, and then as soon as people start chasing it, smart money knows this, and they'll turn around and they will push it back upwards. So they'll push it back upwards and get it above this liquidity line. That way it's no longer resistance, and you get faked out, and all your money gets taken because you thought that this was an actual resistance line, when it's not. This is not a resistance line. This is actual fake liquidity. You know, there's a lot of buy stops. Again, a lot of buy stops resting above this, and a lot of sell limits resting just below it, waiting to get taken. So it would look like, I mean, and so my personal thoughts on Matic right now are that, again, we are still looking to balance, and it might take some time, but I do think we are going to drive lower before we eventually get higher, because we're still not balanced on this monthly. I think we still need to at least get, we need to get a good portion inside of this area here. So that would be anywhere between 1.26 to about 1.15, somewhere around there, 1.151 to about 1.26, somewhere in between there. If we can get in there and then get pushed out really quickly, then we'll have our monthly fair value gap balanced, and then that's when we can finally see a good bullish action happening on Matic. But until then, I think we'll be either trading sideways, downwards. We may go up a little bit again, but eventually I think one of these two things will happen right here. I don't think it'll hit the 15-minute and then bounce off of that and go up, just because there's, again, we need the balance on the monthly. But it could happen. It could happen that we could just come down here, hit the 15-minute fair value gap, and then go higher. Or we could probably hit the 15-minute, go higher, and then maybe use this as the fake liquidity one more time, and then draw down, use that as a drawdown to that area before it goes higher. So that's one more possibility as well. But I mean, I drew this yesterday, and as you can see, we have done nothing but go sideways on Matic. So I do have a buy limit on Matic, and it's a lot lower than where it is now. So that's where my thoughts on Matic are. So anyways, like I said, I personally think we're going to go lower before we go higher. Everything is balanced except for right through here, right? That's the only thing that is not balanced, right? Even though we could get down here, I don't think we will. I mean, actually, this is the monthly fair value gap. I keep saying that we have a monthly fair value gap. This is it. I don't think we're going to eventually get down this far, just because we've already entered the fair value gap once. We don't necessarily have to enter it again. There is another fair value gap way down here, and the reason I think we're probably going to we should get down into these areas is because if we put a Fibonacci on it like I have, anything below 62% is where the institutional levels like to buy. It's where they like to load up. It's where they like to accumulate. And we haven't gotten there yet. We've gotten nowhere near there yet. We've only got to about 50% of that. So, like I said, if I throw a fib on it from the current low to this high here, where I'm drawing, the turnaround point from is right at the 62 mark, and that's about halfway through the daily level. It could possibly get all the way down to this fair value gap right here, which coincidentally is just right on top of the 88.6% pullback area. So in the smart money world, this is where I personally like to have my Fibonacci levels, just because this is where I see the most reaction. Of course, the 61.8, or you can round up to 62 to give yourself a little bit more room if you want to set limits, for your broker. Also, 70.5. 79 generally, because most of the reaction points come at about 80%. So if you give yourself about 1 extra percent, that again, you're giving yourself a little bit more room to actually get in the trade in case it does get down there. You don't want to set it right at 80, because what if it just touches it and you don't get in the trade? Leave yourself some room to get in the trade. So put it at about 79%. And then lastly, if something is really heavy and we are going to see a really big bounce back, the 88.6 is where it does like to come down to. I've seen it hit that point a lot as well, doing my back testing and just doing these all over the place. This theory does come from Forex. You probably haven't seen it in crypto yet. I haven't seen anybody else talking about this theory in crypto, but it works in Forex and definitely works in crypto. A lot of people think that it's a lot, it gets different, Forex is more manipulated and this and that, but I'm telling you, They both follow the same algorithmic theories. I've seen it time and time again. I've been trading for over a year, and I lost a lot of money in my first year. And my first, that was a lot of Forex. The second half of the year, I started learning smart money, and I started learning more about crypto, and I've actually made more money than definitely a lot more money than I lost, in my first half of my first year, that's for sure. And so using the crypto and smart money together, it definitely makes sense that there is an algorithmic theory, and it's based upon liquidity, or based on price finding liquidity, and it's based on it being balanced. It just makes sense, right? Wouldn't that make sense for price to be balanced and also price to find the liquidity? Because if there's no liquidity, then basically nobody would be trading. Basically, if it's making the same move over and over and over again, I mean, I guess people would trade, but then everybody would win, and so then, well, everybody would win or everybody would lose. Either it'd be one way or the other. So there's got to be something in there for somebody, and it's going to be primarily the large institutions that are going to know this algorithm and learn how to use it. That way they can use it to their advantage. And I'm hoping that the smaller people, the people that are just now getting into trading, or can understand this, they can find more people who teach more about it. That way they can get a better understanding of it and enrich their lives, enrich themselves, and get be the next I don't know, Dogecoin millionaire if it ever happens again. But if you like what you heard, if you think this is something that you want to keep learning, go ahead and do me a favor. Hit that subscribe button, hit the like button. It would do me a huge favor. Also, I'll be doing a lot more of these. I've done quite a few on this series. I just thought Matic would be a good one to do next, just because it hasn't been out long. And it would be a pretty easy one to teach, especially with where it's at now. So again, this isn't trying to form a triangle or anything like that. It's really trying to find liquidity and balance itself out. So just wanted to let you know that. Anyways, I'm out of here. Thanks again for watching, and to remember to always keep your pants on, guys, I should say. Girls too, you can keep them on too. Actually, just keep your pants on.